Options prices do not move in isolation. They respond dynamically to changes in stock price, volatility, time, and interest rates. To manage risk effectively, traders use a set of mathematical values called options Greeks to understand how these factors impact an option's price. This module explores each Greek, its significance, and how traders can use them in their strategies. Delta, measuring price sensitivity. Delta measures how much an option's price will change for every $1 move in the underlying stock. Call options have a delta between 0 and 1, increasing as the stock price rises. Put options have a delta between 1 and 0, decreasing as the stock price rises. At the money, options typically have a delta near 0.50, meaning their price moves about half as much as the stock price. Deep in the money, options have a delta close to 1 for calls, or 1 for puts, meaning they move nearly dollar for dollar with the stock. How traders use delta. Higher delta options respond more significantly to price movements, making them ideal for directional trades. Delta also represents the probability that an option will finish in the money at expiration. For example, a delta of 0.30 suggests a 30% chance of finishing in the money. In portfolio hedging, delta helps traders adjust positions to achieve a neutral exposure to price movements. Gamma, the speed of delta changes. Gamma measures how much delta changes when the stock price moves. Since delta is not constant, gamma helps traders understand how an option's sensitivity evolves as prices fluctuate. At the money, options have the highest gamma, meaning their delta changes the most with small stock price moves. Deep in the money or out of the money, options have lower gamma, as their delta is already near 1 or 0. How traders use gamma. Traders holding short options positions must monitor gamma carefully because rapid delta changes can lead to unexpected exposure. High gamma means the position requires active management to adjust hedges as price movements occur. Long options traders benefit from high gamma when expecting a strong stock move, as delta will increase quickly in their favor. Theta, time decay of options. Theta measures how much an option's price decreases with the passage of time, assuming all other factors remain constant. Since options lose value as they approach expiration, theta helps traders quantify this time decay. Near-term options experience the most rapid time decay, especially in the last few weeks before expiration. Long-term options, leaps, have lower theta, as time decay accelerates only as expiration nears. At the money, options decay the fastest, while deep in the money and out of the money, options decay more slowly. How traders use theta. Sellers of options, covered calls, credit spreads, benefit from high theta, as time decay erodes the option's value in their favor. Buyers of options must be mindful of theta decay, especially if their trade thesis relies on a slow price move. Strategies like calendar spreads allow traders to take advantage of differences in theta between short-term and long-term options. Vega, sensitivity to implied volatility. Vega measures how much an option's price changes with a 1% change in implied volatility. Since volatility affects the extrinsic value of options, Vega is an essential metric for traders. Higher volatility increases option prices, as greater price fluctuations create more opportunities for the option to end in the money. Lower volatility reduces option prices, making them cheaper but also reducing their profitability. Long-term options have higher Vega than short-term options because volatility has more time to impact their value. How traders use Vega. Buyers of options prefer high Vega when expecting volatility to rise, as it boosts option prices. Sellers of options benefit from low Vega, as declining volatility reduces option prices. Earnings announcements or major news events often cause volatility spikes, making Vega a key factor in pre-event trading strategies. Rho, sensitivity to interest rates. Rho measures how much an option's price changes with a 1% change in interest rates. While Rho has historically been less important than other Greeks, it has gained relevance in higher interest rate environments. Call options have positive Rho, meaning higher interest rates increase their value. Put options have negative Rho, meaning higher interest rates decrease their value. Long-term options are more sensitive to Rho than short-term options. How traders use Rho. Rho is mainly considered in long-term options, leaps, where interest rate changes can have a more pronounced impact. Traders in low-rate environments tend to ignore Rho, but in rising rate periods, it can slightly affect pricing. Practical applications of options. Greek directional trading. Traders use delta to choose options with the appropriate sensitivity to price movements. Risk management. Gamma and Vega help traders manage volatility exposure and adjust positions accordingly. Income strategies. Option sellers focus on theta to take advantage of time decay, while also monitoring Vega to avoid high volatility environments. Portfolio hedging. Professional traders use the Greeks collectively to hedge positions and create neutral exposure to market risks. By understanding and applying the Greeks, traders can improve their decision-making, manage risk more effectively, and optimize their options trading strategies. Thanks for watching. Please like, share and subscribe. See you in the next module.